Ah, gold. It's timeless, right? Everyone seems to want a piece of it. But with so many ways to invest, from actual bars to little digital tokens, how can you be sure you're not losing money the second you hit buy? Well, in this explainer, we're going to cut right through all that noise to find the smartest way to invest in gold. So, what is the best way to invest in gold? I mean, you've got physical coins, you've got jewelry, digital gold on apps, ETFs, mutual funds. The list just keeps going. It can be super confusing, and you know what? Picking the wrong one isn't just a small mistake, it can seriously cost you. So, let's break it all down. Okay, let's kick things off with the most common ways people buy gold and why your first gut feeling is probably wrong. We're about to pull back the curtain on all the hidden costs that can chip away at your investment before it even gets a chance to grow. And let's just get right to it with a pretty bold claim. If you're buying digital gold on one of those popular payment apps, you are literally losing money the very second you click buy. I know, it sounds dramatic, but trust me, the numbers do not lie. So how does your money just, poof, vanish? Well, let's follow the steps. Say you invest 100 rupees. Instantly, a 3% goods and services tax gets sliced right off the top. And just like that, your 100 rupee investment is already down to 97. But believe me, the damage doesn't stop there. Because when you decide to sell, even if it's just a few minutes later, you get hit again with selling commissions, which can be around 5%. So that initial 100 rupees you thought you invested, it's now worth just 91 rupees and 36 paise. You've lost almost 8.5% of your money instantly. That is not a great investment strategy. Okay, so digital gold is pretty clearly a trap for new investors. But what about the oldest way of all, buying physical jewelry? Here's a really important mental shift you got to make. Jewelry is an expense, not an investment. I know it feels like you're buying a valuable asset, but the hidden costs tell a very, very different story. And here's why. When you buy a gold necklace, only about 78% of what you pay is for the actual gold. A whopping 20% goes to making charges. That's money you will never see again when you sell. Plus, you're paying GST on top of all of that. You're basically paying a huge premium for something that loses a big chunk of its value the moment you walk out of the store. So if digital and physical gold are pretty poor choices for an investment, where should you put your money? Well, this brings us into the world of paper gold, where we're going to compare the two most popular options out there, gold ETFs and gold mutual funds. Let's break them down. A gold ETF, which stands for Exchange Traded Fund, trades on the stock market just like a share of a company. A gold mutual fund, on the other hand, is something you buy from a fund house, and it often lets you do a systematic investment plan, or SIP, so you can invest a little bit regularly. But the real difference, the one that can cost your money, is all in the fee structure. So the key thing to understand here is why the fees are layered. You see, most gold mutual funds are what's called a fund of funds, or FOF. Now, what on earth does that mean? It means the mutual fund you invest in doesn't actually buy any gold. It just takes your money and uses it to buy units of a gold ETF. You're basically paying a middleman to do something you could just do yourself. And this is where that hidden cost of convenience really gets you. Let's follow the money, shall we? First, your gold mutual fund manager charges you a fee. Then they take your money and put it into a gold ETF. And guess what? The manager of that ETF also charges their own fee. So you end up paying for both. It's a fee stacked on top of another fee. When you see it laid out like that, the choice becomes pretty simple, doesn't it? If you want to keep your costs down and get direct exposure to gold's price, you can just cut out the expensive middleman and invest directly in a gold ETF yourself. But wait, before we rush off to buy an ETF, there is one more option we need to talk about, and, it might just be the best one of them all. Let's talk about the government's pretty unique offer. Could this be the ultimate way to invest in gold? We're talking about sovereign gold bonds, or SGBs. These are issued by the Reserve Bank of India, and they have some amazing benefits. First off, you get a guaranteed 2.5% interest payment every single year. On top of that, you get the full upside of any increase in the price of gold. And here's the best part. If you hold them for the full 8-year term, your profits are completely tax-free, no joke. So what's the catch? There's always a catch, right? Well, it's all about timing. Unlike an ETF you can buy any day the market's open, SGBs are only issued by the government a few times a year in specific windows. That means you have to keep an eye out and be ready to invest when a new issue opens up. Okay, we figured out the smartest ways to buy gold, but buying is really only half the story. We also need to talk about taxes, because how your profits get treated can make a huge difference to your final returns. This table breaks down the tax rules pretty clearly. For both digital gold and mutual funds, if you sell in under 2 years, your profit is just taxed as part of your regular income. Hold for longer, and it's taxed at 12.5%. Gold ETFs give you a slightly better deal. The short-term window is only 1 year. But hey, notice what's missing here? The sovereign gold bonds. Like we said, if you hold them to maturity, the capital gains are totally tax-free, which makes them the obvious winner from a tax perspective. All right, we have covered a ton of ground in our quest for the best way to invest in gold. We've gone from the really common but pretty flawed methods to some truly smart, cost-effective strategies. So let's bring it all together for your final takeaway. So here it is, your gold investment playbook. Your absolute best option, if and when you can get them, are those sovereign gold bonds. The next smartest move is a direct gold ETF for its low costs and simplicity. What should you actively avoid? Digital gold, because of those crazy high fees right at the start. And finally, treat physical gold as a luxury. Enjoy wearing it, but don't count on it to build your wealth. So there you have it. You now know how to invest in gold in the smartest, most efficient way possible. But this leads us to a much bigger question for your financial future. Is gold even the right investment for you at all? See, understanding the how is one thing, but the why, that's what will truly define your success.